Hello traders and welcome to Go Forex. Today we're going to talk about a couple of things that I think you as a new trader need to know clearly and understand fully before you start trading real money. Now, if you're here, you may have already started trading full real money and realizing you need to go back and find out some things, or you just may be paper trading like I did for a year. And thought that I was doing really, really well. And then when I started trading real money, things got a little weird. So, two things we're going to talk about today: margin and spreads. Okay, so if you're paper trading, and what you're seeing right now is a paper trade chart. Okay, I'm on the Euro, British pound, and it looks like I'm on the 1 minute chart. Yes, it looks like I'm on the 1 minute chart there. And what you don't see, and let me show it down here. I'm going to pull my little thing up. There's my account balance, $281.73. I have equity of $281.73. Means I don't have any, there's nothing going on right now because I have no positions open. And my profit or loss is at 0. And that's all well and good in a paper trading account. However, the moment that you go live, you start trading on margin. So what is margin? Margin is the money borrowed from a broker to purchase an investment and is the difference between the total value of an investment and the loan amount. The loan amount. Margin trading refers to the practice of using borrowed funds from a broker to trade a financial asset, which forms the collateral for the loan from the broker. A margin account is a standard brokerage account in which an investor is allowed to use the current cash or securities in their account as collateral for a loan. Leverage conferred by a margin will tend to amplify both gains and losses. In the event of a loss, a margin call may require your broker to liquidate securities without prior consent. That's the bottom line for margin. Well, from a practical standpoint, if I was trading on a live account right now, there would be another over here on the right-hand side. See where my cursor is? There would be another column that says margin available. In other words, if I entered a trade and I started entering my take profit, stop loss, let's say I was going to do a sell, what would happen is, based on the risk factor the risk that I put into my order block, right, that would calculate against my margin. So margin is simply reserve money that your broker will not let you trade without giving you a warning, and in very real terms can close any positions you have open if you reach that margin availability. So there have been times that I've been trading a real account, especially with this really small account like $300 or something like that, and in a trade, and it's going against me, and my margin got smaller and smaller and smaller, and then I would get a little notice over here, and it would say you were 2.5% within your margin. You're at risk of being closed out of your positions, yakety smackety, blah, blah, blah. Anyway, know that the margin on an account is simply reserve money that the broker requires for you to stay in the trade, okay, to stay in the game. So that's margin, and it will affect how you trade. If you're paper trading right now, you're not trading on margin. You're just going, you can do anything you want. You can go to your account balance into the negative figure and nobody cares. Nobody's going to do anything. You're not trading real money. But when you start trading real money, you have to watch margin. And here's what will happen. Go here to my order panel. When you start increasing your risk that you want to trade with, you will get and you try to execute a trade that's beyond your margin in terms of your risk, is going to tell you how much margin you're going to have left after you place the trade. You will get a warning that says, no, you can't risk that much money because it's beyond your margin rate. So do your due diligence on margin. Okay, that's another thing. Or I'm just encouraging you to go do that. I may have not explained it like you exactly want it to be explained, but it's how I understand it. So anyway, go do your due diligence on margin. It's going to help you. For history's sake, I traded on a paper trading account for a year before I put any money in it, and I started several paper trading accounts. Okay, I'm going to full transparency. I started several paper trading accounts, simply because I wanted to find out, okay, how much money do I need to invest to make real money on a daily basis or a weekly basis. My $1,000 paper trading account into $20,000 because I wasn't trading on margin. I was risking like 30, 40, 50% on a trade when I thought it was going to go well, and I made good money. I'm on paper, it's monopoly money. I made good money, and I was killing it because I was trading forex, and I was trading crypto, and I dabbled in a couple of indexes, right? And I did really, really well. I mean, I wasn't trading margins, so I could do anything I wanted to with risk. Is a restriction on your ability to trade. Okay, just know that. The next thing I want to talk to you about is spreads, because when I first started, I really didn't understand the concept that spreads will change during the day, and it changes moment by moment with some brokers. In other words, they'll change your spread based upon what's happening in the market. Okay, so what is spread? There's a difference between a forex broker's sell rate and the buy rate when exchanging or trading currencies. Spreads can be narrower or wider depending on the currency involved, the time of day, and economic conditions. Brokers can add or widen their bid-ask spread, meaning an investor would pay more when buying and receive less when selling. And if we go back to my chart, you can see that happen. Yeah, this one might work. Okay, this is the Euro British Pound. And according to my broker, the Euro British Pound, hang on one second, 1.8 spread, 1.7 pips per spread. You see it's moving, okay? 1.7, it was 1.8 a second ago. That's the broker saying, I'm going to change the spread at will. Now, what does that mean? It means that the difference between the ask and the bid is 1.7 pips. And the broker will change that depending upon what's happening in the market and the time of day. Difference between ask and bid. Okay. Your bid price is the price that you are going to pay the currency pair. The ask price is what you're going to pay if you're buying. Okay. So let's just go into a trade right now, and I'll show you what's going on. You'll notice that the price, the candle, okay? The candle tells you what the price is. And then the spread is the difference between the ask and the bid. So right now, this thing is, it looks like it's headed down, okay? It's on the 1 minute chart, it's in a little bit of a downtrend. So without looking at any indicators and without really researching the Euro British Pound for a few minutes, we're just going to enter a sell. Okay, so I'm going to sell. I'm going to sell at the market price. I'm going to take profit after, let's just say 5 pips. Now, remember what our spread was? Our spread was 1.7, 1.8, which is almost 2 pips. And if I get to 5 pips, I'm going to make $5.63. And let's put our stop loss at 5 as well. So we're doing a 1-to-1. I'm going to risk 2% of my paper trading account, which is $5.63. So if I'm successful in this trade, $5.63. If I'm unsuccessful in this trade, I'll lose $5.63. Make a sell, and notice where I got to buy, I got to sell the euro at that bid price because I was selling. Now here's the deal. If the candlestick comes down and touches the price at which I purchased the euro, British pound, I will not get my money. I will not get my money until the ask price has cleared the price at which I purchased. So I'll draw the line. I'll just draw a little line here with the brush. That candlestick, or the candlestick that crosses here, right? It may do this. Okay? It might do that. It might touch. Okay? But until that red line comes down and crosses that line there, I won't get my money. Okay? I will not get my money. So the opposite occurs. Okay, I'll tell you that right now. The opposite occurs if I was doing a buy. If I was buying the euro, okay, I would buy at the ask price, and I would not get my money until the bid price crossed that ask price that I bought the euro at. Okay, and know this. Just as a side note, when you trade a currency pair, the primary is always listed first. That's what you're going to buy or sell against the currency that's listed second. Okay, so right now I'm in a sell, which means I think the British pound is going to increase in value and the euro is going to decrease in value. If I did a buy, I would be placing a trade that says the euro is going to increase in value and the British pound is going to decrease in value. So understand that. You're buying euros. If you're selling euros. FOREX, please email me if you have questions or concerns. I am open to constructive criticism. I am not open to name calling or you suck or what a waste of my time. If it's a waste of your time, don't waste any more of my time either. Okay. So anyway, thanks for watching Go Forex. Have a great day.